Welcome back, everyone, and happy holidays. This week, we'll be taking an article out from the Substack newsletter. The link will be in the description below, and it's a new sequence of articles I'll be writing about stupid BS. Don't want to cuss, not yet at least. Stupid stuff people say, and there's a lot of things that people say that are stupid, and the point of me publishing and creating these articles is in part for me to work through my own ideas and understanding. And someone says something and then you might get emotionally triggered by it, but you're not quite sure why. So then you have to work through what is it that that person said and why was it wrong and what particularly was wrong or not quite right about it. So that's what this article is doing, as well as this channel and my publication is targeted towards more novice, amateur, new investors. And there are so many landmines out there and grifters out there, always trying to capture your attention through techniques, some of which we'll discuss today, to manipulate you and coerce your perception to following them, buying their products, and so on and so forth. So this touches on that. So with that out of the way, I thought that these articles might help people get a better understanding of the reality that they operate in, both in the investing world as well as day-to-day life. Because I try to talk about things that are applicable to the financial realm specifically, but can oftentimes be broadened out into the larger set of experiences called life. So with that out of the way, let's get into this. Stupid stuff people say, Nvidia edition. Today's honorable mention of stupid stuff people say has been taken from a recent podcast I listened to. Quote, Nvidia may be America's top performing stock after more than doubling this year alone, but if you're holding Nvidia or thinking of buying it to get a stake in the $7 trillion AI market, you're going to want to see, anonymous name, AI prediction first. And then the sales pitch continues, but we're not going to focus on that. There's some appeal to authority. He's been a guest on Fox or CNBC, and as though that means anything. I know a lot of grifters, morons, market underperformers that's been on those channels, so that doesn't really mean anything except the fact that people think it means something, which therefore means it means something. But that's a whole phenomenological argument we won't get into. So, let's focus on Nvidia may be, not maybe, but may be, as in recognizing that it is. Nvidia is America's top performing stock after more than doubling this year alone. Now let's dissect that a little bit. Let's evaluate what they're saying. First and foremost, the quote starts off with a blatant lie. Nvidia is not America's top performing stock, at least not year to date. And the reason I bring up year to date is as a consequence of them feeling the necessity to tell you that it's more than doubled this year alone. So let's look at how things have performed this year alone, i.e. year to date. So Nvidia is not America's top performing stock, at least not year to date. So I'll pause on these if you want to pause the screen. So here's the top 20 performing names. The best one is up 1,718%, and as you might think, it's a pharmaceutical company. Interestingly, Carvana is the second best performing stock, up over 1,000% year to date. Matter of fact, it's not even in the top 50 of America's top best stocks year to date. For your viewing pleasure, I've presented you with all the stocks that beat Nvidia. You'll find Nvidia at 70th place. So here you have, there was a Cold. I believe that is the 3 times at number 40. Cold, I believe, is a 3 times inverse natural gas ETF. For those who don't know, natural gas is, falling quite hard. And it's up 525% year to date. And we're still not there. And I understand that there could be some debate between stocks versus ETFs and so on and so forth. But even if you eliminated the ETFs and such out of this, you would still find that Nvidia was not the top. Here you have number 52. I believe that's Hovnanian, which is a home builder stock, which I actually bought for a trade sometime at the beginning of the year and then quickly sold it for a small percentage gain. Well, that was an error in result, being that it's up 237% year to date. WAGMI, that's number 56, WGMI. That is the Valkyr Bitcoin mining ETF. That's up 256%. And here we are, finally at 70th place, Nvidia. Upstart. Now, depending on which graph you look at, on what website, and so on and so forth, which we'll get into in a little bit as a side note, about, if I go to Google, I think I pulled this up, and it said Nvidia was up 241%, and then this is saying 195%. I believe these screenshots were taken on Wednesday, so the 20th, let's just, something like that, late in the week. So Nvidia hasn't gone up 40%, so just keep that in mind. Okay. Assuming good faith. This will be a rather short section. The question we need to ask is, how can we constrain and manipulate the data for Nvidia to be America's top performing stock? To cut to the chase of all the ways we could finagle the data to make that a true statement, I've landed on two ways. The first is the weaker of two arguments, but sadly the more common form of reasoning. The reasoning lies in conflating categories and treating the market synonymous with the S&P 500. As you'll see, S&P 500 component year-to-date returns. Nvidia recognizes it at being up 239%, and so on and so forth. Now look at all these names. I actually did something on my Twitter about how everybody's wanting to blame the pesky Mag 7 for absorbing all the fund flows into or away from the stocks that these fund managers hold. But if you actually look at the top performing names, out of the top 25 S&P stocks, only 4 of the 25 are the Mag 7. So then the question becomes, why weren't these people in these other names? You have Royal Caribbean Cruises, you have Builders First Source, which I've talked about in multiple times and wanted to buy pretty much all year, never have, and probably never will. And then I don't know what number 16 is. JBL, I don't know what that is. So Booking Holdings, Expedia. Anyway, let's continue. The problem with this is that there's more to the set of American stocks than the S&P 500. Insofar as American stocks are limited to the S&P 500, then Nvidia is indeed America's top performing stock. Another thought I had of how to make it a factual statement is that perhaps it's the best performing stock in the American stock market historically. Unfortunately, it's not. Here are just a couple of stocks that have a greater return than Nvidia. And let's zoom in if we can. So we have Apple, Nvidia, and Monster Beverage. So going back to when Apple listed, call it 1980 to 1983, Monster IPO'd in the 90s, late 90s. Nvidia IPO'd in 1999. I believe Apple IPO'd in 1982. Then Monster IPO'd in, we'll get into the Apple thing in a moment. So Apple IPO'd in 1982, Monster IPO'd, I believe, 1997, and then Nvidia IPO'd in 1999. So this is pretty much the returns for each stock, respectively, since they've IPO'd. And what you'll see is historically, Nvidia is up 118,000, almost 119,000% insofar as total returns. But Apple is up 231,000%, and then Monster is up 268,000%. So that means Nvidia is not America's top performing stock. Now, I didn't write this in an article, but I will say it here. What does it mean to be America's top performing stock? Well, it means just that, to be number one. Now, you could have said, to make an honest statement without any ambiguity, that Nvidia is one of America's top performing stocks. That would be an absolute true statement. But, why not say something that's factually false for the sake of hyperbole and emotional exaggeration and sentiment? So price returns, not total returns, doesn't factor in dividends and such like that. Yet again, Nvidia is third place. Apple actually beat Monster in this case, and Monster beat Nvidia. Here we go. As a side note, gathering information is often an interesting and frustrating task. I try to share with you the challenges associated with investing, and today's topic is no different. Let's take Apple for example. CoiFin starts the chart timeline on October 4th, 1982. The Google graph image below shows it starting on December 23rd, 1983. And to make things even more confusing, if you Google when did Apple IPO, it'll tell you December 12th, 1980. This means that there are numerous timelines for Apple, at least 3. Then you try and compare Apple to another stock. Then you have to ask yourself if the same problem exists for the other stocks you're trying to compare it to. I put Apple in quotations because it's as though there's a multiverse of apples. Different apples with different timelines that'll subsequently show different performance results. Then you have to mix and match this multiverse Apple stock with a multiverse other stock. It's irritating as hell to say the least. A way to sort of keep constant your comparisons and control for variables is by using the same data service provider. If you did a quick Google search to compare Nvidia with Monster since Nvidia's IPO, you'd get the following chart. Monster is up 112,000%, and then it shows Nvidia being up, let's just call it 62,000%. Okay. But if you do the same thing on CoiFin, you'd get this chart. Nvidia being up 118,000% roughly, and Monster being up roughly 108,000%. The difference is drastic. The disparity between Google and CoiFin is 3,119%, and the difference for Nvidia is 57,239%. This isn't a mere rounding error. It also provides conflicting information. One chart would lead you to conclude Monster has outperformed, while the other chart suggests that Nvidia has outperformed. My side note is done, and these two charts translate nicely to the next point. You might say that comparing Nvidia to Apple, Monster, or Amazon is not a fair comparison because they all got a head start since they IPO'd earlier. Okay, let's constrain the variables and limit it to the time since Nvidia has become a publicly traded company. If you do that, then Nvidia is indeed America's top performing stock. Nvidia is shown to be 118,949%, and Monster follows it behind at 108,801%. And then Apple and Amazon are well behind it. Now, it's interesting that it's only within the last year that Nvidia has mooned to catch up with Monster. Because before this year, you couldn't have said that Nvidia is the best performing stock, because even if you constrained the data set and data dredged to the IPO of Nvidia to not give Monster a head start, let's say, it still would have underperformed. So it's only in the last year. So just keep that in mind. So due to my lethargy and ignorance, necessity to simplify matters, and for sake of argument, I'll concede that Nvidia is indeed America's best performing stock, with the caveat that we start our measurement as of January 22nd, 1999, Nvidia's IPO date. Given enough data dredging, anything is possible. This also supports why I emphasize paying attention to the level of analysis you view things on, questioning the concepts and preconceived notions in a statement as much as the statement itself, and keeping constant your comparisons and controlling for variables. You must always ask why this particular information is being presented in the way that it is, not just what is this presented information telling me. You must go deeper. Don't believe how important it is? Check this out. The image below starts the timeline only a few short months after Nvidia's IPO. The image below starts January 1st, 2000. And you'll see that Monster's up 124,000% and Nvidia's up 49,000%. You'll notice that Monster radically outperforms if you advance the beginning of the timeline by roughly 11 months. If you started your comparison timeline when the NASDAQ hit its low on October 9th, 2002, you'd have seen these alternative results. Monster being up 137,000%, Apple being up 79,000%, and then Nvidia being up 79,000%, with Apple barely beating Nvidia by 200%, we'll call it. Now, not only has Monster outperformed Nvidia, but so has Apple. To sum it up, different timelines equal different results. Different results equal different interpretations. Different interpretations equal different investor behaviors. So to finish this section up, one could argue that the implicit supposition in the statement, quote, America's top performing stock, end quote, was that their comparison was based upon Nvidia's performance relative to the broader market starting on the date of its IPO, or in regards to any particular stock. In that case, under that constrained narrative, they made a true statement. Now, a less flattering light, let's call it. Assuming humanness. We'll never know exactly what they meant by America's top performing stock, nor how they measured it. Honestly, it's the least of my concerns. In this section, I want to pay attention to the structure of the idea they pitched. Why did they mention Nvidia at all? What was the purpose and function of mentioning Nvidia? What role did Nvidia have in that paragraph? The above quoted one at the beginning of this. Couldn't they have not mentioned Nvidia and said something along the lines of, we have a stock that's part of the 7 trillion AI industry? Why did they provide us with the following variables? Nvidia stock doubling this year alone. America's top performing stock. $7 trillion AI market. Mysterious company they want to tell you about. I'll tell you why. They wanted to preference the mystery stock. By the way, maybe I should have said this already. So the whole sales pitch and market funneling was, Nvidia's best top performing stock up, doubled. It's part of a $7 trillion AI industry, blah, blah, blah. This person has been hosted on major media outlets, and click on the link below and go to this website if you want to learn what this mystery stock is. That's how the advertisement was structured. So, I'll tell you why. They wanted to preference the mystery stock. That's the mystery stock I was talking about. They wanted to preference the mystery stock by framing it in the light of a multi-trillion-dollar TAM, total addressable market, that is also an AI company. Then you're supposed to compare the similarities, not contrast the differences, between the mystery stock and Nvidia. And since Nvidia is America's top performing stock, you're supposed to make a false equivalency through hasty generalization and jump to conclusions that the mystery stock could also perform well like Nvidia has. This occurs when you broaden out the category to a more abstract level, AI stock. They're implicitly guiding and coercing your attention, knowing that many people will fall for it. We as humans fall for it because thus far we have incomplete information. So our brains try to force-fit narratives into what we know. And we know all these details of Nvidia and know that this mystery stock has a lot of similarities. So we take a few leaps and bounds in our brains to make sense of things and fill in the blank regardless of whether we have enough information to come to an informed decision. Why else would they say it the way they did? If I assume good faith, They at best are alluding to the belief that AI technology is in a secular trend with favorable tailwinds. They then use Nvidia's stock performance as an example of how it's translating to shareholder returns and profits. You might have heard this idea expressed under the following phrase, "A rising tide lifts all boats." The fallacious nature of their reasoning. Nvidia stock is an AI stock and it doubled. Mystery stock is an AI stock and you're supposed to infer that it could double. Just because a stock within a sector has performed well doesn't mean that other stocks within that sector have performed well or that the overall sector has performed well. A trait which is true for an individual doesn't necessarily hold true for the broader group in which that individual is a member of. That would be called a stereotype. And aren't we supposed to judge a stock by the content of its character and not by the industry that it's in? There's a larger cultural phenomenon going on here that the advertisement is taking advantage of. They know that Nvidia is being used as a synthetic proxy and placeholder phrase for the AI industry. The broader abstract category of AI subsumes Nvidia within it. Over time, Nvidia and AI stock become interchangeable and synonymous. After enough people, enough times, bastardize and co-opt their speech, you'll hear talk about an AI stock and you'll think of Nvidia's performance or vice versa. Then when I tell you that something is an AI stock, you'll correlate that with Nvidia's performance. So they're playing on that already heightened sense of awareness and correlation. But just in case, they overtly mention Nvidia to prime you to start thinking that way. Think of when someone says tech stocks are doing well. Most people will think of the Mag 7. Now, if I say that the Mag 7 is doing well, you very well might say something along the lines of tech stocks are doing well. But are tech stocks doing well? Are all tech stocks doing well? Is IBM and Intel doing well? After all, they are tech stocks. This is what happens when you speak in absolutisms and oversimplify things. You can merely alter your speech to be honest, but people rather lie through omission or hyperbole than simply be honest. What you should say is that some tech stocks are doing well. This is how lazy humans are. Tech stocks are doing well versus some tech stocks are doing well. God, why is it so hard to add a single word to a sentence, especially when a single word separates fact from fiction? Think of the example, lift with your knees, not your back. People can make that a true statement by substituting the word and for the word not. So just imagine that, lift with your knees and your back, or lift with your back and your knees. The problem is that people are pathologized, and like any good pathologized person will do, they'll defend their speech rather than correct it. You might accuse me of splitting hairs and nitpicking. I would find such accusations comical. You know why? Because if your boss said, "We're giving our employees a raise," and you then don't get a raise, you'd be upset. But why? Well, it's obviously because you're splitting hairs and nitpicking. You definitely wouldn't be upset that they spoke of a broad category when they meant that only certain members of that broader category were getting raises. But it's the same difference. Tech stocks are doing well equals employees of the company are getting a raise versus some tech stocks are doing well equals some employees are getting a raise. But I digress. I would myself identify what the sales pitch did as propaganda. They structured the information in a fashion that would provide a biased and misleading result in order to promote and publicize a particular point of view that allowed them to segue into the stock that they were trying to promote and the email they wanted to harvest. They do this through time-tested techniques of funnel marketing. They get you curious about a stock, you give them your email, and then they bombard you with advertisements and discounts to buy their product. The sales pitch made a major error. Most grifters know to speak in vague, ambiguous, and general terms. They know they should stay as decontextualized as possible. The Art of Subduction by Robert Greene made this clear. As a side note, I would recommend practically all the ones I can think of, Robert Greene's books. The beginning of chapter 10 use the demonic power of words to sow confusion starts off with the following. Keep your language vague, letting them read into it what they want, using writing to stir up fantasies and to create an idealized portrait. Seductive oratory, end quote. Seductive oratory is a thing of beauty. You might ask, what does Nvidia have to do with anything? It's a subtle and plausible deniable conflation of categories. Is Nvidia an AI stock, or are AI stocks Nvidia? Just because Nvidia did well doesn't mean other AI stocks will. So why bring it up? As though Nvidia is preordained and has blessed and given permission for other AI stocks to go up in share price. Nvidia is a subconstituent of a broader class of AI stocks. And by the way, this all presupposes that Nvidia is an AI stock. In order for Nvidia to be America's top performing stock, you'd have to measure it in a way that practically no one does. When people are comparing stocks, they don't compare it to the date of the most recent IPO participant. If you're going to do that, then you need to communicate that, since it's not a conventional traditional practice. Of course, that presupposes that the advertiser has integrity and the desire to be intellectually honest. Fallacies galore. A equals B, B therefore A. Topically applied, it takes the following form. Nvidia performance equals AI stock. AI stock, i.e. the mystery stock, therefore Nvidia-like performance. This looks like someone jumping to conclusions as to what an AI stock might do based upon what Nvidia has done. I noted above how words and ideas get fused together and become interchangeable. Mag 7 becomes interchangeable for tech stocks, or in this case, Nvidia becomes interchangeable with AI stocks. The problem is that it's just not true. Another problem is that everyone thinks that they're so smart and don't fall for such nonsense. Nvidia has certain qualities and characteristics of AI, but that doesn't mean that other AI companies share in the same attributes, traits, qualities, properties, similarities, or characteristics as Nvidia. A equals C, B equals C, but A doesn't necessarily equal B. Nvidia equals AI stock, mystery stock equals AI stock, but Nvidia's performance doesn't necessarily translate to mystery stock performance. And what the hell is an AI stock anyway? It's a broad, ambiguous, vague, and ill-defined category by most. Is Whirlpool an AI stock? Why wouldn't it be? What does it mean to possess the essence of AI? It also comes close to being a false syllogism. All AI stocks are or will be doing well. Mystery stock is an AI stock. Therefore, the mystery stock is doing or will be doing well. The alleged proof for the above statement is the fact that Nvidia is doing well and thus supports the implicit argument that all AI stocks are doing or will be doing well. This is why Nvidia was included in the sales pitch. This comes as a consequence of how the word Nvidia and AI are used interchangeably as a verbal shortcut, which leads to corrupt, distorted thought. Quite frankly, I hate how humans talk this way. In an upcoming article, I'll be writing on this very phenomenon. A couple of quick examples of this sort of bastardized absolutist speech that you've most likely experienced are the following. I never get what I want. Lift with your knees, not your back. Masks don't work. Masks work. Sugar is bad. Okay. And finally, we'll discuss the Texas sharpshooter fallacy. This is an informal fallacy that occurs when differences are ignored but similarities are paid attention to. The point of this is to coerce your thought to mislead you to infer a false conclusion. Once that happens, you'll be more than willing to click on their link, which is the goal of their funnel marketing. It's a common practice of people to underrepresent one point to overemphasize another point. People don't stop with that though. They take it a step further. They'll try to eradicate a point to emphasize another point. That's called lying, misleading, distorting, misrepresenting, just to give it a few words. Take the example, lift with your knees, not your back. Another common phrase I've heard is, it's not what you know, but who you know. They're both exaggerative and misrepresentations and factually false statements of reality. These phrases are spoken in this way to emphasize the latter, but by diminishing the former. Another problem is that people start taking these literary tools literally. I've seen people who perceive their hard work as not paying off and were becoming nihilistic and despondent and saying, what's the point of working hard when all that matters is the connections you make with upper management? They've actually come to believe the non-literal phrase. They made the one error you should never make. They bought their own bullshit. The best way I can demonstrate this idea is by showing you a picture. Complementary color combinations are the colors that sit on opposite sides of the color wheel. Combining these colors creates an effect of high contrast, catching the eye and leaving quite an impact. Examples: red and green, yellow and purple, orange and blue. It's based on a relationship between two colors that are opposite each other on the color wheel. It's based on the behavior of light and the perception of color in the human eye, and it's used to create a strong visual contrast and a sense of depth and movement in a design. Well, not only do we do this with colors, but we do it with our speech. A simple way to make you understand this is if I shine my headlights in your eyes on a dark night versus the middle of the day. The headlights are bright in part as a consequence of the ambient surrounding light. This is what I mean by the framing effect. The environment that you present something in alters a person's interpretation of what's presented. The lumens are the same. The headlight hasn't changed. Yet, you'll tell me that the headlights are bright in one scenario and not bright in another scenario. This is the consequence of your ineptness in regards to your ability to articulate an idea, not on the reality of the situation. We'll get more into that as well in the upcoming article that I discussed earlier. So what's the environment of the quoted stock pitch? Well, here's a chart of mentions of AI during earnings calls. And you'll see how it's really ramped up in this last year. If you're trying to paint someone a picture, figuratively, and you're trying to tell them about red, you might then contrast it with green. You're trying to make the idea you're speaking to pop. It's a rhetorical device. A rhetorical device, otherwise known as a stylistic device, a persuasive device, or more simply, rhetoric, is a technique or type of language that is used by a speaker or an author for the purpose of evoking a particular reaction from the listener or reader or persuading them to think in a certain way. The incredible thing is that most people are clueless that they do this or that they're being influenced by such things. And if they do know, they seemingly don't care. They don't care because of their overestimation in their ability to identify manipulation. That complacency only leads to a heightened chance of them being manipulated. I've said this to many people and they seemingly don't care. As a side note, this has led to an interesting moral dilemma. If you tell someone that they're easily manipulated for such and such reasons, and then they dismiss you, is it okay for you to prey on them or take advantage of them? After all, they're now a willful participant. They do know better. You're essentially taking advantage of the fact they're too stupid to know that they're stupid. I've decided against it, but there's a strong case to be made. In conclusion, just ask yourself this. Does the advertiser want to imply any correlation between the mystery stock and Nvidia's performance? If not, then why did he bring up Nvidia in the first place? Does he want you to think that they're inversely correlated? Then he'd not mention Nvidia as an AI stock because it would imply the mystery stock as a sell, not a buy. So what does that leave us with? I'd like to invoke the spirit of the Sherlock Holmes quote. Quote, when you have eliminated the impossible, whatever remains, however improbable, must be the truth. End quote. That leaves what's left. The advertiser wanting you to think of Nvidia and the mystery stock as being positively correlated. Faulty analogy. They want you to assume that because two things are alike, in one or more respects, part of a $7 trillion industry, they are necessarily alike in some other respect, stock performance. The very fact that this stock pitcher thinks that that's even a remotely appropriate way to conduct themselves tells me that I should have nothing to do with them in either personal or business relations. People feel the need to lie even when the truth is on their side. It's so bizarre. The need for hyperbole turns a true and bullish statement into a false one. As far as I'm concerned, the quote started off with a false premise. The reason is simple. Nvidia isn't America's top performing stock. The reason for that is that no one measures or compares historical stock returns in the way that would be necessary to make it the top performing stock, as we did earlier in the first section. They could have told the truth by saying Nvidia is one of America's top performing stocks. Simply switching out may be with the phrase is one of would have made it nearly impossible to refute. I asked earlier if Whirlpool is an AI stock. I wasn't joking. They manufacture multiple everyday home appliances that use AI. TVs, baby monitors, vacuums, speakers, washers, dryers, fridges. So why isn't Whirlpool getting an AI premium? I'll let you think about that. As often is the case, I like to escalate and abstract out. The ideas I've put forth today are scalable. If you're an AI stock, you get privileges in the form of a higher earnings multiple and thus a better stock performance and thus a richer payout via your compensation package if you're a C-suite executive. That sounds familiar to what's chronically going on in the media headlines. Elon, first time I've ever quoted Elon, might be the last time, but nonetheless, Elon touched upon this idea in the 2023 Deal Book Summit interview. At around 17 minutes and 30 seconds, he had this to say. There is a natural affinity for persecuted groups. This has led to the funding of essentially any persecuted group or any group with the perception of persecution. This includes radical Islamic groups. If you generically, without condition, fund persecuted groups in general, some of those persecuted groups unfortunately want your annihilation. So let's put that in different words and bring it back home to what this article is all about today. Put differently, indiscriminate, hasty generalizations that are oversimplified and thus decontextualized lead to poor decisions and outcomes sometimes. He could have said that too, but he phrased it the way he phrased it because that was relative to the topic being discussed at the summit, and that is also what I've articulated here today. Indiscriminate, hasty generalizations that are oversimplified and thus decontextualized lead to poor decisions and outcomes sometimes. You could apply that to numerous domains. Taking a job, buying a car, buying a house, dating someone, practically any ideology, any belief system, stock investing, bond investing, practically everything. Okay, so what do you think happens when you fund an AI stock that is masquerading as an AI stock when at best it's tangentially associated? It runs the risk of annihilating your money. Is there a difference of magnitude between genocide and losing money on a stock pick? No shit. But that misses the point. The point is that these fallacies, biases, and cognitive errors express themselves everywhere. And you'd be wise to recognize them in all of the ways they're expressed. And the better you become at identifying them, the better off you'll be and society will be. This is the beauty of intersectionality and identity politics. Preferences and discriminations are predicated upon your identity class to a small niche group. And that small niche group seems like a moving goalpost. This is why even poorly run AI stocks have had massive repricings lately. It's why cannabis stocks or EV stocks had a bubble. They were for a short period of time the identity class to be a part of that got preferential treatment as a consequence of, well, their intersectionality. It goes to reason that if you identify as an AI stock, then you get an AI premium, perhaps larger than just being a tech stock. It's these sort of identity politics to seek the favor of the rulers, i.e. the investors, that cause these sort of linguistic games to get played. And the linguistic games I'm talking about is the citing of AI on earnings calls. Now this chart goes only up to Q1 of 2023, but Q2 and Q3 even saw a higher usage of the citing of AI on earnings calls. It's not like Patrick Boyle has a podcast that you should subscribe to and listen to. And earlier in the year, I'd say the first half of the year, he had a podcast about something AI companies, autonomous, something. And then he talks about how this stuff's been around since, I want to say, the 1950s. And then it's just a beautifully crafted podcast, like practically all of his podcasts. And it's definitely worth a mention. So it's like, okay, so the reason I bring that up is you look at 2013, it's barely mentioned. What, was AI not a thing 10 years ago? I'd beg to differ. Now, I would say, if anything, it was underrepresented in the past because that wasn't the buzzword. The reason it's being quote-unquote overrepresented isn't because there isn't a fundamental inflection point occurring with the development of ChatGPT, the catalyst that set this all off seemingly. It isn't that. It's that, oh, I can use this language and weaponize it and use it as a tool to manipulate other people to seek favor on me. If I identify with this language, then I will be accepted. And that is a very dangerous game. And with that, we are done here today with this article. Cup of Coffee Capital is a reader-supported publication. To receive new posts and support my work, consider becoming a free or paid subscriber. So with that out of the way, let's get on to the weekly stock performance. And I'm now on my Substack also posting my weekly performance report, which, well, shows you this. It shows you my year-to-date returns, year-to-date, listen carefully, being defined as end of the prior month. So right now, if you go on the site, you'll see year-to-date, I think it says 20, let's just say roughly 25%. That was calculated end of November. That's not factored in anything that's happened in December, because I'm not going to update that weekly. So there is that caveat you should know about. And I think I noted that in the weekly performance report. But people struggle to read, so thought I'd say it. Which is why I'm reading these. Because, I mean, quite honestly, I'd listen to more publications and newsletters if they were read to me. And that's just fact of what it is. I mean, I pretty much only listen to books, not really read them. So that's why I'm doing this. And as opposed to my normal haphazard fashion of doing a slide deck, I can be more articulate and say what I mean and have less misspeaks than I alternatively would if I was just saying things and talking. Even though just talking is a nice casual conversation, you don't feel like you're being talked to, so to speak, as opposed to having a conversation with, which I really actually do like and enjoy. And the problem is I sacrifice articulation as a consequence, and I don't like that. Anyway, with that out of the way, portfolio performance, I'm up this week 4.4%, or this prior week, I should say, since it's the weekend, as me publishing this. And boy, things are ripping. That they are. That they are. So, Sibanye Stillwater, I mean, there's a week left. So, I'm still outperforming the market, but I've seen I've seen pretty drastic things happen in the market in a week. So just because I'm outperforming this week does not mean that next week, even though it's going to be a lower volume trading and a 4-day week, so anything could happen. But just here recently, some more recently purchased names. Sibanye-Stillwater, I'm up 23% on. I can't remember. I mean, could have been, a month ago, maybe? It's funny. So I'm 2 for 2, man. I really wish I held that EQX position. That'd be such a nice brag, which I normally don't do or show any emotion at all. I try not to. Because the problem is when things go up, you get emotional. But if you get emotional when things go up, the probability of you getting emotional when things go down also increases. And then that increases the probability of making an unforced error. So the only way I know to curtail my emotion, the only way I know how to handle myself is just don't be emotional. And that's taken a lot of work and discipline and time, but that's where I'm at. That's also why I'm biased in me, I guess, saying negative things about something, the risks to an industry or name or sector. Or a lot of times you'll hear me talk about how a chart looks like crap. You don't hear me too often say a chart looks good. And that's just because I try to lower my expectations, curtail my speech, try not to get excited. Because if you get excited when things go up, you probably get excited when things go down, and that's not a good way to make money. It doesn't make you any more money when you get excited on the way up. If anything, it makes you FOMO and YOLO and double down on a position that's ripping for only to get pulled back. And then what? Well, pulls back, retraces, and then what? You just get emotional to the downside, except more because you're negative biased, loss averse, and so many other things. So then what happens? So your emotions on the way up cause you to over position size, let's say, which is dangerous. And then emotions on the way down causes you to be a forced seller because you're a victim of your emotions. So emotions kind of need to not be a part of the picture, or a bare minimum part, not any more than what's necessary. How about that? So saying good things, I bought ATI, I'm up 14% on that. Kind of irritates me in some sense, to be honest with you. I appreciate it contributing to my portfolio performance because I really would like, for my first year of being Cup of Coffee Capital, to outperform the market. Kind of a large point of the channel to demonstrate and be an example of the fact that one can outperform the market. But the problem with ATI going up is I didn't get the position I wanted to in it. And the other stock in that specialty alloy producing space is up, geez, man, like 30%. And I wanted to buy it. And, well, that seemingly isn't happening. Kodiak Gas Services, KGS, wrote an article on that one on my Substack and made a video on my YouTube channel. Pretty much everything is going up. I mean, Carvana is up 1,000%. So none of this speaks to the underlying fundamentals of any of these businesses. Now, some of these were oversold, so they're bouncing. There's perhaps a short squeeze in, was it palladium or platinum? It's hard to know what stocks are going up because of the fundamentals and what stocks are going up because of sentiment. And is that even a stupid thing to try to figure out? And does it matter? And, like, for instance, Tidewater, Transocean, and Valaris in the past week have done well. Is that because of they were oversold? Is that because of what's going on with the Houthis, or however you pronounce them, in the Red Sea, the stuff going on in the Straits over there, and blah, 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 all that drama? Because I'll tell you what, shipping stocks, which I think I brought up last week, I kind of wanted to YOLO as a speculative play over that drama, but I was concerned of the downside risk and not the upside reward, since I was trying to window dress the end of year, so I didn't really want to take any gambles, even though there was an asymmetrical risk reward. And from the time that I wanted to buy Zim ticker symbol ZIM, it's up 50%. Now, is what it is. Is what it is. But is all that going on? Is that what causing Tidewater to do so well? If you recall, I think it was at one point I was only up 8% on Tidewater. When it fell there a couple of months ago, that one day I think earnings report came out and it closed on the day down 13%. And I bought, I think when it was down 11% that day, I think I bought my first, oh boy, what was it? What was it, 68, 63, something like that? Anyway, what I'm getting at is that I sat in that last share purchased underwater for 2 months. And then just within a week or two, I'm now up on my Tidewater position from 8% to 34% in not that long of a period. And as a percentage of my account, Tidewater is 10%. Then we have Valaris. Interestingly, here lately, Valaris is doing better, unless I'm mistaken, than Transocean is, which is interesting because the first half of the year saw Transocean doing better, especially in 2022. Transocean was doing better than Valaris. Valaris had some, concerns of management and this and that, and Transocean repriced from a going concern to not a going concern, and then saw it massively go up. And unfortunately, or fortunately, at this point, unfortunately, Transocean is 9% of my portfolio, and I'm down 7.5%. Now, that's not as bad as I was being down 16 or 18% on it. Is what it is. St. Joe, can't wait to see what the report comes out for Q4. It's doing well. Not nearly as well as the home builders or the supply providers and manufacturers of building products have. Builders First Source is incredible. Then LPX is a dog of this. I mean, BCC, Boise Cascade, BLDR, Builders First Source, names like that. LPX is not doing nearly as well as them, but it's up 24%. So actually that could be, interestingly enough, if you look at my names, SRUUF, that's that dip I bought that I was afraid it was going to either precipitously fall or rocket, and it rocketed and didn't fall, so I never got the position size in that because I wanted to make that like a 10% position. But interestingly enough, I'm only outperforming the stock market, the S&P 500. Was the S&P up 23%, 25%? Let's just say it's 25%. If it's up 25%, then only 4 of my names are outperforming the market. Now, this is the problem with time-weighted average rate of returns, because you can say, how am I outperforming the market? And the consequence of that is the time-weighted average rate of return is how I'm outperforming the market. Because the genuine, and I might do this, is not to say, what did the S&P 500 do between January 1st and December 31st? You should be comparing this portfolio, if you're doing this yourself or something like this, where you contribute money on a regular basis. You should be asking yourself, what is the time-weighted average rate of return for the S&P 500 if I contributed $50 a week each week for 52 weeks? Because that's in reality what you would be doing. You wouldn't have invested all 52 weeks of cash flows up front at the beginning of the year. So even comparing, I'm going to have to do it, but if I beat the market, I'm not going to do it. Well, anyway, starting next year, I'm going to start doing that because that's the real test, which is interesting because money managers don't provide you with that. Now, of course, most people don't give their money manager a certain amount of money every week. But you could say, well, when you gave me these deposits, this is your time-weighted average rate of return, and then let's compare that against my benchmark, which is the S&P. But the problem, people don't do that, even though that's a more factual representation of your performance in relation to the benchmark, the way that you would invest in the benchmark. The problem with that is it offers more complexity. And, well, as I've noted in this article today, people like to bastardize and oversimplify their speech in absolutist ways due to essentially avoiding the complexity of the world instead of recognizing what's inept and inadequate in themselves and then rising to the occasion. They instead just, well, misrepresent and mischaracterize the world into something that it's not, so that way they can then speak of this fictional, curated world. It's very interesting how people talk, and it's caused me to have quite a number of problems with people, unfortunately. Or fortunately, I'm not really sure. But not really sure how I got on that tangent, but here we are. So Kinross Gold is actually my best performing stock of the year so far. We have a week left. And good. You know, that's why I bought it. I thought it was going to do well, and it has. So at least it worked this year. I think with that out of the way, I'm going to be done here. Thank you for watching. Happy holidays. And until next time.